Now, fellas, so far, you now understand why currency value can silently destroy wealth, what deflationary assets are, and the three powerful examples, which include Bitcoin, gold, and farmland. But here is where it gets even more interesting, because the next two assets are the ones most people overlook completely, yet they often create the strongest long-term wealth. Like I told you, this video is divided into part 1 and 2. And in part 2, we will break down high-quality dividend stocks, scarce real estate, the biggest mistake people make, and a simple action plan to start protecting your wealth immediately. Welcome back to Money Code Africa. This is the part 2 of the 5 deflationary assets to protect your wealth during 2026 currency crisis. And asset number 4 is high quality dividend paying stocks. Now let's move into something many beginners overlook completely. Yet it is one of the most powerful long-term wealth tools in modern finance. We are talking about high quality dividend paying stocks. These are shares in companies that have strong business models, generate consistent profits, and return part of those profits to investors as dividends. If in Ghana, if you are looking for some of these companies, I can give you at least 2: MTN, GCB Bank. But not all stocks qualify here. We are talking about companies with strong brand power, essential products or services, and long-term demand regardless of economic conditions. You may ask, why does this matter during currency crisis? When the currency weakens, local cash loses purchasing power. But strong global companies often earn in stronger currencies, operate across multiple countries, and increase prices within inflation. That means your investment is not tied to one struggling company. Here are some of the advantages related to this type of investment: passive income through dividends, long-term capital growth, exposure to global markets, and some risk may include market volatility. It requires a lot of patience because it's not for short-term investing. Needs proper selection. Not all companies survive. Through modern investing platforms, Africans can now access global stocks more easily than before. This opened the door to companies that have survived recessions, inflation cycles, and currency instability. You may ask, who can invest in this type of assets? And this type of assets is for investors who are long-term investors, people building passive income, wealth builders thinking globally. And here are some key ideas to consider. You don't just want to save money. You want to own part of businesses that grow even when currencies weaken, even when currencies are in crisis. And now, let's move to the 5th and final asset: scarce real estate in high demand locations. Now, let's talk about one of the most emotionally driven but powerful wealth assets: real estate. But not all real estate qualifies. We are talking about scarce high demand properties in strategic locations, not just land everywhere, but places where population is growing, jobs are concentrated, infrastructure is expanding. You may ask, why is real estate a deflationary asset in practice? Land is limited because it's still connected to the land issue. Land is limited, but demand keeps increasing. Especially in urban areas, you cannot create more space, but more people need it. Some of the advantages to having real estate as a deflationary asset is long-term capital appreciation. It means everyday rent and everything keeps rising. We all know that. Rental income potential, tangible assets, real ownership. But it also comes with some risks. And the risk includes high entry costs. You know, some of these assets that are in vantage points, places where you can make profit. If you want to acquire them, you have to pay an amount, exorbitant. Even the land is priceless, especially a place like Accra. Maintenance and legal complexities. You know, land litigations in those type of places are very wild. Illiquidity. You can't sell it so quickly. In cities like Accra, Lagos, Nairobi, and others, urban migration is increasing. Housing demand is rising. Infrastructure is expanding unevenly. This creates both opportunity and risk. And that means you would ask, who is this investment best for? It's best for long-term wealth builders, investors with capital stability, people seeking rental income. And one key insight to consider: wealth is often built not by owning many properties, but by owning the right properties in the right location. Now, I want to move on and want to talk about some common mistakes people make in trying to invest in deflationary assets. Now, let's step back for a moment. Even when people learn about these assets, they still make costly mistakes. Here are the biggest ones. Number one, holding too much cash. Cash feels safe, but during currency devaluation, it silently loses its value. Number two, following hype. People rush into Bitcoin, land, or stocks without understanding them. Number three, no diversification. Putting everything into one asset increases risk dramatically. And I think every investor knows this. Number four, emotional investing. Buying when prices rise and selling when fear hits. This is talking generally about top stocks. Number five, waiting too long. Many people wait for the perfect time and miss the opportunities completely. And as you and I both know, the right time rarely comes. But here's the truth. Wealth is not destroyed by lack of opportunity. It is destroyed by lack of preparation. So here are some simple action plans that you can put in place when you want to start investing in deflationary assets. Let's make this practical. You don't need to invest in everything at once. Start with a simple structure. And this, step number one, emergency savings. Always have an emergency savings so that when something goes awry, you have something to hold you up. Keep 3 to 6 months of expenses in cash for stability. Number two, learn before investing. Understand each asset before putting your money in it. This is simple. Number three, diversify gradually. Don't rush. Build positions over time and make sure you invest in more than one thing. Step four, think long term, 3 to 10 years. These assets are not get rich quick scheme. They are assets that require patience and time. Number five, stay consistent. Financial success comes from discipline, not timing. The goal is simple: discipline. Protect purchasing power first, then grow wealth second. Let's bring everything together. We looked at 5 key deflationary assets: Bitcoin, digital scarcity; gold, physical store of value; productive farmlands, real world essential assets; dividend stocks, income producing global businesses; scarce real estate, location driven, long-term value. Each one protects wealth in a different way. But the deeper lesson is this: in a world of currency uncertainty, your survival depends on ownership, not just savings. Money sitting idle loses power over time, but assets with scarcity tends to preserve or grow value. Now, fellas, that was a long one there. If you found this video valuable, here's what you do next. Like this video. It helps more people discover financial education and Money Code Africa. Subscribe to Money Code Africa for more wealth building insights. Comment below, which of these 5 assets do you trust the most? Share this video with someone who still thinks saving alone is enough. And watch the next video on building financial freedom in Africa. Because your financial future will not change by chance. It changes by knowledge and action. See you in the next one.